Morning, Clyde Russell, Asia Commodities and Energy columnist at Thomson Reuters, Paul Hicken, Editor-in-Chief at Petroleum Economist, and Dr. Charles Elinas, CEO of Cyprus Natural Hydrocarbons Company and Senior Fellow at the Global Energy Center Atlantic Council. So thanks a lot, everyone, for joining us. Welcome back. It's good to see you all. Lots happening. Let me start with you, Paul. Sort of the overnight or early morning news, of course, of Saudi Arabia declaring that it's going to be extending its 1 million voluntary cuts through to the end of the year, not just in October, which perhaps, did that surprise the market? Obviously, it blipped at above $90 or expected.
Yeah, so the 1 million barrels a day cut to be extended was expected, but to extend it beyond that to the December, it was a little bit of a surprise, and that's why you've seen this little extra boost. I think you see the expectations around the barrels coming off the market. That I'm at OPEC at the moment, and the mood has clearly been that the Saudi Arabia strategy has been a success. You've seen prices rise from the early 70s up towards the $90 barrel mark as a result of that lollipop that's been continued to be extended. But you have to wonder at what level that we start seeing demand destruction, that we start seeing concerns about a cap, some sort of cap that the market takes on board. I mean, if you think about it as well, while the market is certainly seen it as a bullish signal, I think there are certain concerns or caveats around China, and I think that's probably not been as widely spoken about at the moment. Certainly from the rooms that I've been in and the corners of the rooms I've been at APEC, there's certainly concerns around China demand. I think there's concerns. You've seen the PMI data from China, it's below 50, which signals a slight contraction. The economy isn't picking up in the way that some commentators have talked about, especially the bullish ones. And there is that concern. And on top of that, you've got to remember the China SPR concern and the way that China may not buy or bring crude back into the market to help cap prices. So you've got a sort of double whammy there from China that's could well act as a cap. So while it's a bullish move, there are still certain concerns around on the demand side.
Yeah, exactly. That is it, isn't it? Clyde, let me go to you on that. I mean, we're above 90 now, we're at 90. The question is, like, will we hit that 100 really as these months pass? And China has been obviously in the news, Clyde, as it has been all year. And, you know, as Paul just said, you know, OPEC will keep going unless or until demand, you know, destruction kicks in. So can you give us a bit of a picture, Clyde, now that we're back at sort of almost the start of the fourth quarter? What's the outlook for China? What's the sentiment in Asia on how demand might perform in the fourth quarter, having a bit, you know, obviously a bit lackluster in the last few months?
Well, it's quite interesting. Like Paul, I've been at the APEC event, and last year everything was very much just a Ukraine-Russia focused thing. That was the only topic. It crowded everything else out. This year, it's quite different. But the problem is, while people agree that, you know, like OPEC plus, China demand, those are the big issues, no one has a unified view. And that's the kind of thing that is quite interesting. You know, there's a lot of people who say Chinese demand is going to come roaring back in the fourth quarter. You know, OPEC plus is going to relax its production, you know, restrictions, or it's going to extend them. You know, there's no clear consensus. And that's what's been quite interesting for me, is the oil market is actually fundamentally confused at the moment. As far as China goes, yes, there are some things that are absolutely true and set in stone. Demand hasn't been as strong as people thought it would be, but that doesn't mean it won't improve in coming quarters and coming months. And the other thing is, you know, how will the Chinese respond to higher prices? Traditionally, what's happened is that they've trimmed their imports. If you actually look, Chinese imports at the moment I reckon can range between 10 and 12 million barrels a day. That's a 2 million barrel a day difference. That's quite a lot. And I think, you know, if you start to see those prices consistently above 90 and start even hitting higher, the Chinese will trim their imports. And, you know, they did. You saw that in July that they trimmed because prices in April when they were buying for July were high. Now we've had a run up in prices, but that's not going to show up in imports until like November, December. But at that point, it would be logical to expect that they would start to go down. But whether that's enough to lower the oil prices or change OPEC Plus's you know, tactics at the moment, that's another big question.
Yeah, as you said, lots of questions and as much confusion in oil markets probably as we've had all year, really, that clarity. Although although they've been relatively stable from a price point of view. OPEC has achieved that more or less. But there is still lots of confusion over the factors that are going to feed into that going forward. Dr. Charles, welcome again. Let's talk a bit about Europe, where you're based. And Clyde just mentioned the Ukraine war is kind of like last year's news. Of course, not really. We have a lot of destruction and impact there on the ground in Europe. But from an oil market point of view, from an economy point of view, what's being felt in Europe now? And of course, give us your opinion on this $90 now, how it's going to feed into inflationary concerns, where in Europe still that hasn't been brought under control.
Well, it definitely won't help. I mean, in Europe at the moment, the greatest problem is that industrial output is down. Germany is suffering massively. The industry in Germany is going down. The use of energy in Europe is going down. For example, only this week, the results for electricity use in Europe were announced. Electricity use went down 5% during the 6 months of 2023, and the use of fossil fuels like coal and gas for producing electricity went down dramatically, while renewables have gone up to replace these things. So Europe is still pushing very hard towards decarbonization, getting rid of fossil fuels. There are more calls to reduce dependence on both oil and gas and reduce dependence on Russian imports. Russian imports of oil have gone down dramatically. Only about less than 3% of European oil comes from Russia. And even gas went down dramatically. Less than 13% of European gas comes from Russia. So Europe is also caught in between where it is now and elections coming for the European Commission next year. And there is a bit of retrenchment, a bit of looking backwards and deciding how to go from there. In terms of adopting more and more clean energy policies. The tendency now is to stick to what they have and not go any further, because there is also increasing resistance within Europe against adopting more and more green policies. So Europe is in a state of turmoil. That's
turmoil and confusion, like everyone. But I mean, the green policies, the Green Deal, if you like, that is a medium-term target still, isn't it? But I mean, Europe did do a very good job last year, luckily, because of weather issues, the weather wasn't too bad. It managed to up its storage. Gas storage is now at 90%. And make other adjustments, obviously infrastructure-wise. One of those was obviously to start building up its LNG infrastructure. Paul, let me go to you with that in terms of looking forward to this winter, and I'll get Clyde's perspective on Asia on LNG. But from a sort of Europe point of view, Paul, and US, for example, LNG not coming to Europe, going to Asia, being used in the US. Are there any concerns about spikes again and shortages on that front going for, obviously not yet, but still a very precarious situation, isn't it, the spot market there?
It is, and you saw that with what's happened with Australia, with the potential strikes and the sensitivity to the gas market, even across in Europe, to those potential strikes. And while storage is full, Europe's done as much as it can to get itself in a position of strength going into the winter. At the same time, I'm at Gastech now after being at APEC, and the mood again is one of can't be complacent. If there's a bad weather, the storage will deplete quite quickly, and then there's really only there's not so much flexibility in the system as yet. Europe can only do what it did last time, which was potentially bring down demand, manage the demand, which it did, or there's a little bit more capacity. Obviously, they've done a brilliant job in terms of building out infrastructure, particularly Germany, which has had its own landlocked issues. But it's done a very good job in building out infrastructure, so it can bring in extra supply. But there is some supply coming on, but it's more the supply is likely to come in next year and the year after. So this winter is still one of certain concern.
Okay, Clyde, just to get your comments a bit on sort of Asian appetite at the moment for sort of LNG prices are reasonable at the moment. So, would Asia be buying up more or putting in orders for more at the moment? And then, Clyde, I'd like to get your opinion on China's generally its stimulus program and where we're at there ahead of the fourth quarter. A lot of people still criticizing that it's still not doing enough to pump consumer demand, if you like, to do what it takes, putting aside the property sector issues.
Well, it's quite interesting that, we now look at $13, $14 per MMBTU for spot LNG as reasonable. A few years back, that would be seen as extremely expensive. It does show how much the world has changed. I think on the LNG, there's definitely more appetite for some spot cargoes in Asia. We have seen the Chinese come back into the market at these levels. And you're also starting to see the Japanese buy up for the northern winter. Your gas storage levels are perhaps a little bit lower than their 5-year averages. So, there is appetite there. Although you got to say at this kind of price level, your price-sensitive buyers like India and Pakistan are still largely on the sidelines. They're taking some cargoes, but not a lot. As far as China and stimulus goes, I think what we've actually seen is a paradigm shift. We always got used to the idea that when the Chinese did stimulus, they did it hard. They spent a lot of money. They loosened the monetary policy taps, and there was this huge rush, particularly in construction of infrastructure and things like that. We're not seeing that this time. We're quite frankly, I think, unlikely to see it. So, we've got to get used to a sort of paradigm shift in how the Chinese are now stimulating their economy and what they're trying to achieve. And what they're really trying to achieve is sort of, a low inflation growth of around 5%. So, but without stoking inflation or doing that sort of thing. And they're managing a whole range of other demographic issues as well, which is starting to show up in their, with their labor force and things like that. So, it's quite. We're in basically a new China phase, and I think we're starting to get used to that. That doesn't actually mean that they're not going to keep buying vast amounts of commodities. They are. But it's not going to be the huge growth driver that we saw in the past years. And I think, the market's going to have to reassess that.
Yeah, and it's like the rest of the world has got to adjust rather than China adjust. China is adjusting, and it's fine. It is a matter of everyone else getting used to that new dynamic. Dr. Charles, let me go to you. You mentioned gas. We mentioned that gas storage in Europe and that Russian gas this year has declined dramatically, obviously, into Europe for obvious reasons. Let's talk a bit about Russian oil, Dr. Charles. And, we've seen less oil go to India in the last 2 months. We've seen talk of, Russia can now abide by its OPEC plus cuts more because fundamentally it's beginning to have problems in its production, or it has having to slow down. Where do you hear that the Russian production's at going forward in terms of what should we expect from it in the next quarter?
I think the problems you mentioned are becoming quite serious in Russia, and the Russian production isn't going to go up. That's why it's complying. I mean, if you remember, earlier in the year, it didn't comply to OPEC requirements. Car production now is complying, and it's actually taking the lead in some respects. So the problems they're facing are going to continue. Production isn't going to go up, and Russia is going to face increasing problems, but in a way that counterbalancing that now by expanding their LNG exports. And as you probably have seen, they have shored up LNG. Novatek has been able to resume construction of its LNG plants. New LNG plants are being considered. So it looks as if, in a way, in terms of energy, Russia is putting more emphasis on LNG exports at the moment. Oil, I'm not so sure where it's going to go from where it is at the moment, to at least during the next quarter.
And would you agree with the sort of opinion that's beginning to sort of sink in that the war, let's just talk a little bit about the Ukraine conflict, that sort of settled into a medium to long-term stalemate in a sense of back and forth, and that we're not going to really see that wrap up anytime soon? We did have one person on the podcast yesterday who was saying they do think it's going to wrap up sooner rather than later, but most people are just sort of saying, well, this is just now something that's going to continue on the side.
Well, it isn't going to wrap up that quickly. I mean, all indications are that the war is in a kind of a stalemate and will stay like this for quite a while, to the extent that Russia is now looking forward to seeing Trump back to see a change in the situation if Trump comes back. I don't think they see any change at the moment, and there is definitely no appetite by Europe or by especially the United States to change direction, to force Ukraine to go into negotiations. So it looks at the moment, and especially with in new reports telling us that Ukraine is having some success in its counteroffensive, it doesn't look as if there is going to be a cessation that quickly. It will be there for a while, and it is having an effect on Russia. I think we're going to see more of that, and hopefully that will not lead to some kind of escalation to bring an end to the war by unconventional means.
Yeah,
that's my concern.
Hopefully not. Paul, let's talk a bit about other OPEC a little bit. Now, we've mentioned Russia and the Saudis' latest move. What about other OPEC producers, Iran, Nigeria, that have been sort of slowly improving, let's say, their production output this year? Is Saudi in any way trying to sort of obviously preempt and counter what is more oil coming from other OPEC members ultimately this year? Is that what it's doing, do you think? Where are we at with that?
I don't think so much that per se. Yes, I mean, Iran's already been coming back. We've seen that around crude oil coming back. Oil's come off, the condensate's come off its floating storage. Iran's been a real poster child, if so to speak, for the way once prices get to a certain level, and how much the US will turn a blind eye to sanctions in one area if they want to try and squeeze a country somewhere else with sanctions. Energy affordability comes sharply back. It's been actually energy affordability, more than even security in a way, has been the story of the past couple of years for gas and oil. It's something you see with across the energy markets. The fact that coal has come back across Europe, in Germany and UK and Australia. We're looking in gas tech, and you see that how many projects that would get off the ground in Southeast Asia if gas was on a comparable price to coal, and it isn't. And as a result, coal is still in a way a big part of the energy mix, especially in Southeast Asia and in parts of Europe. And I think the same thing now with oil, with sanctions, and with Iran, Venezuela, Nigeria, and some of the others. West Africa have got its own issues, and it's coming back, but it's still very slow. And I think it's more about, for Saudi Arabia, about working from a position of strength. Earlier this year, it was in a position of not necessarily weakness, but it was quite angry at the sort of disconnect between financial and physicals, the banking wobbles we saw earlier in the year, and the price was down to 70. And it was kind of infuriated that some of the kind of measures and cuts that had taken place weren't lifting the market. It'd rather be in this position now, where prices are in the sort of 85 to 95 range, where if prices do continue going up, it can increase production from a position of strength. And while it says, through to the end of the year, it can easily reverse ferret on that at any point in time. And it possibly would do if prices do continue to creep above into triple digits.
Yeah, and obviously start to really impact demand. Clyde, let's talk a little bit about products and Asian products, Asian demand for that. I mean, where are we with the jet fuel situation after the summer travel season across the world? But also in terms of sort of exports of refined products from China, given what's happening domestically in its demand situation, what's the outlook there for the fourth quarter?
Well, I think it's quite clear that the Chinese are going to export more product. They have given out a new round of quotas that were slightly more than what the market was expecting. There's likely to be a further round around that November, December thing, and that will lift the exports. I also describe China as a somewhat reluctant exporter of products. They don't, as a policy position, they don't really want to. But when the refiners have got, they've built up this massive refining spare capacity effectively. And if they want to run their plants at anything approaching profitable levels, they're going to produce. And if they're not able to sell that into the domestic market, they're going to look to sell it outside. That's the refiners put pressure on the government. We need to export, and there's easy money there. As we know, gas oil margins have been very, very strong in Asia, so I think they're seeking to capture some of that. So I expect to see more product come out of China in the fourth quarter, and I think that will be something that is a definite trend. Whether the problem with trying to predict Chinese product exports is it is not a rational market-driven situation. What actually happens is it's entirely manufactured by the whims of the bureaucracy. So it's a very difficult thing to sort of predict. But logically, we should see more exports. Whether that's enough to draw down margins or improve the availability of refined fuels in Asia, that remains to be seen. Certainly, there's still quite a bit of a squeeze on diesel. But yeah, it's if the Chinese do come back in the market, it should lower that sort of pressure.
A squeeze on diesel, and of course, diesel is one of those products that is very linked to the construction sector demand, isn't it? So that's sort of an indicator as well of that things aren't possibly too bad. Clyde, just staying with you, just on the India, as we're in Asia, the statistics and data that have come out recently, that in the last couple of months, on its lower intake of Russian crude, is that partly due to maintenance? I know there was some maintenance of refineries in India, but is it discount related? I mean, that discount has shifted, hasn't it?
It has, but at the moment, Russian crude is still cheaper for Indian refiners than the alternatives from the Middle East, even though it doesn't give them an ideal product slate. So running it through their refinery, it's better for them to run Middle Eastern crude. But OPEC Plus, particularly the Gulf producers, they've been taking away the medium sour barrels from the market. So the Indians don't really have much option. So at the moment, it's still about $5 cheaper on a delivered basis. So for them, it's a good idea. So I think they'll continue to do it. What we're really seeing is we're bumping up against the limits of how much physical crude can be shipped from the Baltics and through around to India. That to me is a constraint. I mean, I've been talking to some of the Indian refiners. They'll keep buying as much as they possibly can. But if you actually look at it, I mean, Russian crude is now something that's almost 40% of India's imports, and like before the Ukraine war, it was like 2%. So it's a huge uplift, and I think it's now a fairly settled trade, and I think you'll see variations according to maintenance issues or freight constraints, just getting enough ships. But overall, I think this is a trade that still makes sense and will continue.
Okay, Paul, I'm going to go to you and talk a bit about the US economy, please. But I just wanted to just say about the survey question, obviously, about oil hitting for $100. It's a simple question, maybe not in a simple answer. Will it hit $100 by the end of the year? People are sort of going towards that sentiment, I suppose, now that we're in a bullish streak. Clearly, that would be expected. But people were also dismissing that possibility only a couple of months ago. So we'll see what result we get there. Paul, let's talk a little about the US economy and obviously the impact it may be having. I mean, we talked about China, but the US is still strong. There's talk of interest rates rises slowing down, but now we've got oil back at $90. What's going to happen to inflation? Back to square one. We're kind of like yin and yang on that policy, but also just on the economic front, you've still got wage pressure. We haven't really seen demand weaken in that economy, have we yet? So from a Fed policy point of view, we're still looking, slightly, continuing with the path that they've been on this year. What's the sentiment that you've had on the US economy at APEC and at Gastech?
Yeah, I don't think you can never say the US is out the woods at all in terms of inflationary issues, and especially now, obviously, energy creeping back up, oil prices back above 90, especially going to an election year, it creates another complication. In a way, we haven't talked about US SPR, and they've almost they've used their bullets up early now, and we're looking to buy it back, and now they've sort of missed that window. And it's back above, and what's going to provide a cap to prices? Only really demand destruction now. We've seen more difficult times in the past. The US have commented about the Saudi Arabian OPEC plus cuts, and they've sort of had their tail between their legs in a little way over the past since back in November last year, where they admonished them and got it wrong in terms of, OPEC called it right and Saudi Arabia. Have they called it right this time? While the market is initially reacted to that higher prices, I think still it's early days to comment on where the market might go over the next 3 to 4 weeks, 6 weeks, depending, like I said, on China. And so I think we still have to be mindful that maybe our prices may not still reach $100. It's still it's an open conversation to be had on that. And certainly Saudi Arabia judging the physical market on a different parameters to the paper market. So that's one to look at. And I think, like I said, I think the US now are slightly boxed themselves in the corner, having used up their SPRs, sanctions.
Gasoline is almost at $4, inching up towards $4, that $5 kind of level they don't like, for sure, which yes.
And I would like just to add a comment to what Clive was talking about, which was diesel. We were back here last year with the diesel shortage. And again, I think it's an important point to raise, which is Saudi Arabia making those cuts feeds into that shortage, because the Saudi crude is what really, makes up makes a lot of diesel products. So that is going to feed into that. And staying towards the end of the year, diesel's one to watch as being as a barometer for the economy, the global economy, and also one for the fact that Saudi are taking crude out the market.
Dr. Charles, we have a story on the bulletin today about Iraq-Turkey oil flows are not expected to resume before October. Is that a surprise? There was some, much more optimism earlier this year on Iraqi oil flowing again, in terms of the Kurdistan issue. Where are we at with that? Do we see sort of an expectation that in the fourth quarter we may see those flows resuming more smoothly?
Well, it is a surprise. I mean, there was an expectation that flows would start, and but it is now very likely that before the end of the year, flows will resume. I mean, Turkey and Iraq are edging towards sorting out their differences, and we should be seeing oil flowing through Ceyhan before the end of the year.
Okay. Clyde, the G20 Summit, let's just talk a bit about that coming up in India, and Xi Jinping not going, Putin obviously is not going, and there's talk of a meeting between North Korea and Russia. I mean, from an Asia point of view, geopolitically, how are things feeling these days in terms of the China-India dynamic, the China-US dynamic? There's nobody's really paying attention. I mean, where are we at with that in terms of the geopolitics of the new global world order, if you like? Big question, I know, but is that feeding into thinking at all? We had our survey question up about whether geopolitics is dominating China's thinking more than economics. Where's China's stance, what do you think, on that these days? Or is it just concerned about its economy?
Well, I think the Chinese are working through a whole range of issues on their domestic economy. On a geopolitical thing, they've actually been quite clear. They believe that they need to play a much bigger role. They don't like the sort of unipolar US-led order, and they think that they have a natural position in doing that. What I think is, if I talk to a lot of people and I think about it myself, what we're really seeing is the world splitting again into sort of what you might broadly term the authoritarian states versus the sort of democracies. But even within that, there's all sorts of things. If you do get Trump back in America, does Trump join the authoritarian states? So he's quite clearly, that's what he likes to be. That's what he would like to see. So it's, I think a period of great uncertainty, and I don't think people are really, got a handle on how it's going to be. But certainly there is a very definite China-India rivalry. And I think what you're actually seeing with things like the US Inflation Reduction Act is you're starting to see that, we've got to really change how we do supply chains and things like that. And the Chinese are thinking that as well. They don't want to be reliant at all on the West for things as well. They're happy to trade with us, but they don't want to be reliant, just like increasingly the West doesn't want to be reliant on China.
There you go. There's our survey question. 67% saying it's going to hit $100. Clyde, what would you say? Would you have pressed yes or no? What did you press?
I was in the 33%. I think as you get to that $100, you're going to start to see some serious demand destruction. And it's a psychological thing. So people, will defend that level. I can't see $100 just on the back of the Saudi cuts. I think it would take something else to drive it over there. But if you start to if retail fuel prices around the world, not just in America, where I live in Australia, diesel's now almost as expensive as it was at the peak of the Ukraine conflict, or just in the aftermath of the invasion. It will start to crunch economies again. So yeah, I think 100 would be optimistic.
Yeah, and I mean, of course, then the baton will be in Saudi's hand, and of course, it has built up that extra capacity, hasn't it, through these cuts? So it could very well come in and calm things down if it chooses to do so, supposedly, unless we really have a surprise jump in demand beyond what we're expecting. Okay, well, we're running out of time, I'm afraid. Thanks so much, gentlemen, for joining us. Dr. Charles Elinas, Clyde Russell, and Paul Hicken, thanks so much for joining us today. And there we have our halftime talk for this week, which is coming up in an hour. With Ali Rashid Al Jarwan, who's the CEO of Dragon Oil, of course, and he and an interview I did with him, Sean did with him, Sean Evers, he's quite convinced that the industry and countries have moved on from the Ukraine war in terms of functionality, and that the focus now is elsewhere. They've gone, those hiccup problems in 2022 have dissipated, and the industry is facing sort of a new dawn. So a very interesting interview there. I encourage you to watch that in an hour or so. Thanks so much, everybody, for joining us, and have a great day.
Thank you.
Thank you.
Bye-bye.